We just got Nigeria inflation March expectedly showing an increase as energy prices spiked up. Nigeria's headline inflation rose to 15.38% year on year in March 2026 as expected from 15.06% in February, driven by higher transport, food, energy costs, and some currency volatility. On a month-on-month basis, the headline inflation rate in March soared to 4.18%, more than double the previous month's 2.01%. The food inflation rate in March was 14.31%, much higher than 12.12% in February. On a month-on-month basis, the food inflation rate in March was 4.17%. Core inflation month-on-month also notably spiked to 4.03% in March from 0.89%. Meanwhile, Oni, head of equity research at Stanbic IBTC, had noted in the latest PMI report that ongoing Middle East tensions would raise inflation through higher fuel prices, potentially leading to prolonged elevated interest rates and slowing demand if the situation persists. Monetary policymakers may still hold interest rates unchanged at 26.5% at their May 19 to 20 meeting, subject to the April reading, which comes just ahead of the decision. They will also by then have more information on how higher global food, fertilizer, and oil prices will feed into inflation and potential second-round effects. Rising energy costs in a resource-driven economy like Nigeria with limited fiscal buffers for targeted interventions make the urgent transition to a more efficient digital economy less exposed to resource price fluctuations absolutely essential. Nigeria's return to the global frontier market indices in September is anticipated to boost investments and strengthen the naira, but may further stoke widening inequality as the top-tier corporates benefit more. FTSE Russell will reclassify Nigeria from unclassified to frontier market status starting September 2026. This also comes as the International Monetary Fund downgrades growth in sub-Saharan Africa from 4.6% in its January forecast to 4.3%. The Nigerian economy is also now expected to grow by 4.1% this year, down from a prior forecast of 4.4% for 2026, so says the IMF. Nigerian Finance Minister and Chair of the G24 Coalition of Developing Countries, Wale Edun, said during a briefing at the IMF World Bank spring meetings in Washington that multilateral institutions should do more to support vulnerable countries weather the economic shocks of the war in the Middle East. Hello, this is Global Business Insights, where we look at the world from a business perspective and bring analysis and updates that help to navigate the context. The International Monetary Fund has revised its global growth forecast for 2026 to 3.1%, representing a decrease of 0.2 percentage points compared to January's projection. This adjustment is based on the assumption that the ongoing US-Iran conflict will not continue for long and that oil prices will average $82 per barrel for the year. Other forecasts indicate the possibility of much higher average oil prices. The crude price trajectory and impact on global growth is not as easy to gauge. The time required post-war to fully restore the supply chain and how much fair premium we still get all depends on when and the kind of peace that emerges. We also are in a much more resource efficient and digital operating environment with much more energy source diversification than say in 2022. And this, including the demand destruction, could tone down the expected impact. The IMF attributed the reduction in its growth outlook to energy price increases and supply disruptions resulting from the conflict involving Iran, cautioning that the global economy could approach recession should the situation escalate further. According to the IMF's adverse scenario, where the conflict lingers and oil prices average $100 per barrel in 2024, global growth would slow to 2.5%. The United Kingdom was worse hit by downgrades, with growth now expected at a tepid 0.8% in 2026, much lower than the January 1.4% forecast. Pierre-Olivier Gourinchas, IMF chief economist, attributed Britain's growth downgrade to heavy gas imports, insufficient storage, and weak growth following the Chancellor's £30 billion tax increase. Energy exporters such as the US and Canada are expected to see a much smaller hit to growth. The US economy this year is now seen as growing at 2.3% from 2.4% in the January estimate.
The global economy was on a steady growth trajectory, around 3.3% in recent years, and we were looking to upgrade our projections. The war has stopped that momentum, and we now project growth of 3.1% this year, under our reference forecast, with inflation rising to 4.4%, a sharp departure from the previous trend. The economic impact will depend on the duration and scale of the conflict, and could be worse under our adverse and severe scenarios, as we show in our report. It will be highly uneven across countries, hitting countries in the conflict region, commodity importing low-income countries, and emerging market economies hardest, through three channels. First, higher energy and food prices themselves. Second, persistence in wage and price inflation. And third, a confidence shock that tightens financial conditions. Risks are firmly to the downside, including a further escalation of the war, new trade tensions, or a reassessment of the profitability of AI investments. On the other hand, a swift resolution of the war, productivity gains from a faster adoption of AI, or easing in trade tensions could uplift the global economy. Central banks need to communicate clearly their readiness to act if needed. However, if the conflict is short-lived and inflation expectations remain well anchored, they can afford to wait and assess. With very little room left, fiscal policy must act prudently. Any fiscal support should be targeted to the most vulnerable and temporary, with clear sunset clauses. Importantly, fiscal policy should not complicate the task for central banks. Beyond the immediate measures to contain the crisis, countries should also use this opportunity to invest in energy security through investment in renewables. With the right policies and stronger global cooperation, the damage can be contained.
Novo Nordisk announced a partnership with OpenAI, the creator of ChatGPT, to enhance drug development. The Danish pharmaceutical leader plans to leverage OpenAI's tools to analyze data, pinpoint promising drug candidates, and accelerate its processes. Novo, known for selling Wegovy, a weight loss medication, has released several new products this year in an effort to regain market share from its American competitor Eli Lilly. Amazon will acquire Globalstar in an $11.57 billion deal, helping its satellite business as it tries to catch up with Elon Musk's Starlink. Companies are investing billions in the lucrative market for satellite-based connectivity, with Amazon adding Globalstar's 24 satellites to its existing network of over 200. The Nasdaq closed up 2% and the S&P 500 rose 1% and near its record closing high on increasing optimism about prospects for a Middle East resolution. Investors also assessed the latest batch of bank earnings and U.S. producer price inflation readings. Banks in the world's largest economy continue to outperform expectations, driven by volatile capital markets and consumer resilience despite an ongoing war. In the US, the producer price index rose 0.5% last month, less than the 1.1% expected. Core PPI, excluding food and energy increased just 0.1%, also below the forecast of 0.5%. Year-on-year, all items PPI jumped 4%, its largest gain since February 2023, while core PPI was up 3.8%. JP Morgan Chase announced its second most profitable quarter ever, beating first quarter earnings and revenue expectations. Profit was up 13% to $16.5 billion. Earnings per share at $5.94, better than $5.45 expected. Fixed income trading revenue rose 21%, exceeding estimates by $370 million. However, the bank lowered its 2026 net interest income outlook, causing shares to initially dip in pre-market trading. JP Morgan closed the previous day trading flat. Goldman Sachs quarterly earnings rose 19% year-over-year to $5.63 billion. That's $17.55 per share, beating analysts' expectations. Net revenue reached $17.23 billion. Investment banking fees increased 48% to $2.84 billion, driven by strong advisory and equity underwriting performance. Goldman shares ended the trading session up 2.11% yesterday. Citigroup posted its highest quarterly revenue in 10 years, with earnings per share up 56% year-over-year at $3.06 per share versus the expected $2.65. Revenue reached $24.63 billion, beating estimates of $23.55 billion. CEO Jim Fraser stated the bank is on track to meet its return targets and is nearing the end of divestitures. Due to its global presence, Citigroup is seen as more affected by geopolitical factors than other banks. Citi shares rose 2.61% by the end of the previous day. Wells Fargo announced first quarter earnings per share of $1.6, exceeding Wall Street's projected $1.58. The company, however, reported revenue of $21.4 billion, marginally under the anticipated $21.8 billion. Wells Fargo shares plunged 5.7% at close yesterday after back-to-back quarters of disappointing revenue performance. Still on banks, both Bank of America and Morgan Stanley announced today strong results, topping expectations on both revenue and bottom line. Performance was bolstered by strong equity sales and trading, as well as healthy consumer banking and stable asset quality in the United States. Asian markets traded higher as hopes for a US-Iran deal continue to rise. Shares of information technology services provider Samsung rose 20% following news that private equity firm KKR will buy it $20 million of its convertible bonds. Global markets continue to anticipate the resumption of Iran peace talks and are closely monitoring the US blockade of the Strait of Hormuz. There is some sense of relief that the IMF's recent downgrade of global growth was not substantial. Attention remains on market sentiment, which improved following positive bank earnings but still held back by ongoing uncertainty regarding the direction of the Iran conflict. Oil futures fall as the market hopes for breakthrough US-Iran negotiations, while the ceasefire in the Persian Gulf holds despite collapse of talks over the weekend. The International Energy Agency now expects global demand to decline by 80,000 barrels per day this year versus a previous forecast for growth of 640,000 barrels per day. For the second quarter, demand is now expected to fall by 1.5 million barrels per day, which would mark the sharpest drop since COVID-19 slashed fuel consumption. The demand destruction will continue into Q3 as scarcity and higher prices persist. Well, that's all we can take on this special edition of Global Business Insights. This is Bode Oshosami. Do not forget to subscribe and hit the notification button. Bye-bye.